Welcome to A Day in the Life. I'm Darren Bloomfield, your host. Joining me today is Seung Yoo, our risk manager. We met at RIMS a few months ago at an event and have kept in contact and just wanted to bring you on and just explain to us a little more about the risk manager career path and your day to day and how your past experience in insurance got you to where you are.
Yeah, so glad to be on. Seung Yoo from Regal Rexnord Corporation. I'm the director of global risk and property management here. I've been here for about 9 months now, and it's been a fun ride. And looking forward to the conversation.
Yeah, definitely. So can we go through kind of your background a little bit? Like you were an underwriter for like 5 years and had some other experience as well. Like how do you think that background helped you prepare to be a risk manager of kind of knowing like what an underwriter would look for when they're evaluating your insured that you're working for internally?
So yeah, before being at Regal Rexnord, I was at Takeda Pharmaceuticals. I was the U.S. risk manager there for 5 years, and then prior to that, I was at Chubb, which I was actually an ex-ACE employee for about 5.5, 6 years. So I was a global casualty property underwriter, and prior to that, I was 2 years as a brokerage at ECBM as an associate broker. But I think my experience at being an underwriter helped quite a bit because there wasn't one particular line of insurance that I really enjoyed underwriting, but I got to dip my hands in different types of insurance like auto, general liability, products liability, property, business travel, so and even K&R. So I got to dip my hands in a lot of different types of insurance coverages. And the technicality aspect, as a risk manager, you need to answer coverage questions. If the general counsel of your company or the CEO of your company gives you a call and asks, hey, do we have this covered or what's excluded? You don't have time to go back to your brokers, and they rely on you as an expert. So for me, as when I was at Chubb, being an underwriter where I had a lot of I thought I was more on the technical side of things, and the fact that I was able to write endorsements and review coverage lines and explain coverages to risk managers kind of led me to becoming a successful risk manager.
Yeah, no, that makes a lot of sense, and especially how you put it of you're the in-house expert for the company as a whole, being like kind of that experienced buyer, sophisticated buyer, and then just kind of like you're kind of on the spot, like you have to know what's going on. And I really like the way you put it, like there's not time to always defer to the brokers that you're working with.
Yep. No, exactly. That's and again, it's my personality and expertise kind of fit the risk manager role, but again, the underwriter role was also great, and I wouldn't have left the position if I didn't get the opportunity at Takeda.
So kind of on the note of using the brokers and kind of picking who you're working with and taking the most advantage of those specialties that they have to offer, how do you kind of go about that and understanding where these brokers can add value to what you're doing internally with risk controls and benchmarking to your peers and finding out where you need to have coverage?
Yeah, so as a risk manager, it's your job to understand the risk of the company that you work for, the types of insurance coverages that are available, and then the insurance structures that the company should consider. So I'm an advocate for insurance or risk financing for my specific company. Brokers work with hundreds of different clients. They're going to have the data, what type of insurance they purchase, what kind of losses they see. So we mainly work with brokers. We rely on brokers who are experts in different types of insurance, like a financial line where it's D&O, fiduciary insurance versus liability, and there's property. So there's so many different insurance lines out there that you want the expert in that specific field to provide you consulting on what the trends are in the marketplace, and then who has the relationships with the underwriters. And that, I think the relationship portion is a very important aspect, but also it's important for them to understand, risks for Regal Rexnord. It's surprising that depending on the underwriter, they might have an expertise in writing manufacturing facilities versus farms or hospitals. So it does vary, and you want to work with the expert that's knowledgeable in your field, and because you want to make sure that they're providing the right information, right types of coverage and limits, because that's directly going to be reflected on your recommendations to your C-level suite in your company.
Yeah, so kind of what you're saying of you're internally the risk manager, you're going very deep into the one company that you're representing, but then on the brokerage side, they kind of have that pulse on the market, have that understanding of what's going on in this peer group and just other trends on the more holistic market of what's going on. How would you recommend that somebody earlier in their career would kind of decide if they want to go into like the brokerage or underwriting side and have more variety and a broader exposure to businesses, or work for one insured as a risk manager? How would you advise someone to kind of make that decision?
I personally believe, and this is how I approached it, was working with a larger company, like on the brokerage side or on the insurance company side, and seeing various types of risk, and understanding and kind of seeing what interests you. You want to be in a position where you're able to try different things versus when you start at, let's say, at Regal Rexnord or Takeda Pharmaceuticals, all you're going to know is clinical trial insurance, or insurance that a pharmaceutical company may need or a manufacturing facility may need. So I believe it's best to position yourself to open yourself up to more opportunities in the future. So not that you can't go from a risk manager to a broker or underwriter or vice versa, but it's you want to be in a position where you meet a lot of clients or meet a lot of different brokers and personnel. They can kind of help you provide their experiences and guidance on what you can do and what's out there in the market.
Mm-hmm. And kind of on that note, have you seen anyone coming, out of college and going straight into the risk management side, maybe like an analyst, or is that not really like a entry level role in that way?
No, a number of my friends, again, I graduated from Temple University as a risk management and insurance major, so a lot of my friends did go different ways, and I would say 80% of my peers went to an insurance broker or insurance company, or like a TP, like an insurance vendor related, like a third party administrator where they handle claims, or like the actuarial firms or consulting firms. But there are a few handful of friends that colleagues, peers that have gone to the risk analyst role, and some have enjoyed it, some have not, and came to the insurance company side. So I think, honestly, it really does vary on the type of personality and type of person you are. If you go into a risk analyst position and excel at learning about the single company, you have a good mentor, like a risk manager that's able to position you to an advancement as an insurance manager or risk manager, and then director of insurance. So I think it does vary on the company that you go into. But there's, again, there are companies out there that only to fulfill a risk manager role, they want to look at just the analysts, people who had prior company experience. So I think it does vary. I wouldn't be worried or, you know, concerned that just because you're in a risk analyst role of a company that you can't venture out into a brokerage or um, insurance company industry, because I think it depends on how much your willingness to learn
Mhm.
and continue to improve your knowledge based on insurance. And as long as you have that, I think the insurance industry is a wonderful place, and there are just so many different variety of positions and roles out there for you.
Yeah, no, I couldn't agree more. Can you go back to what you were saying about kind of that personality of how you learn or how you want to interact with others, and then lining it up to kind of like the lifestyle of how your career would kind of function is kind of different, as the risk manager of your one client, and your client is who you're working for, as a risk manager. But on the brokerage side, maybe more out of the office, more like lunches, more entertainment, kind of more selling lifestyle. Can you, I mean, you've seen, all three sides there. Can you kind of talk about like that lifestyle, like how it's kind of different?
Yeah, it can vary, and again, it's limited to how much you are willing to. It's limit. It's honestly, it's kind of it's limited to the effort that you put in, right? So, as a underwriter, which I was underwriter for, so I was a production underwriter, and my main goal was to go out and underwrite new accounts. So I was always traveling on the road, meeting with brokers, meeting with risk managers, attending events, for them to give us a submission, give us a shot at pricing their insurance. Um, that involved a lot of travel, and at that stage of my career, my first child was born, and I wanted a little bit of less travel, so I was kind of looking towards a more of an internal role, and kind of the corporate role where you're like a referral underwriter. But then the Takeda pharmaceutical jobs came, and it's imagine I used to deal with and meet with hundreds of brokers, underwriters, and other personnel, versus now I had a team of three at Takeda. And my peers and supervisor was in Switzerland, Japan, and London, so you don't get to meet them as much.
Mhm.
So I think it was an adjustment period, but I didn't mind it. But for someone that was in a risk analyst role that that only worked with a team of one or team of five, right? And then now you go to a underwriter setting, and now you're asked to visit 10 people each week, right? So it's an adjustment, but in terms of lifestyle, you can make it as much fun as you want. I mean, just because you're an analyst doesn't mean the broker wants to see you downtown to have dinner, to have lunch, right? Some of them may not like to, but it doesn't mean that you can't. So I think it's as long as the individual puts in the effort, you could enjoy the lifestyle. However, there are differences of where if you have a team of 10 in a risk management department, not all 10 we're going to be able to go to an annual RIMS conference, right? Where, I think next year is in San Francisco. It might be difficult to go to that because it's hard to send all 10 folks there. However, like you've been to, there are the local chapter events where, like in Wisconsin or in Chicago, where you're able to attend. I believe there's a number of things in San Francisco and Indiana. I'm sorry, St. Louis and Indiana, where there's local chapter events where you can attend for low to no cost at all. So I think again, it's the effort that you decide to put in, and the opportunities are out there. It's just not many people know about them.
Yeah, and kind of what you're saying is like on that lifestyle piece, it's kind of who you're interacting with, and like how many people are kind of on your team. And like kind of with that, like when you're internally, how do you kind of figure out like what's really going on, in the company that you're, the risk manager as? Because that's not like you're not only buying insurance, you're also figuring out if you can transfer or reduce the risk. How do you kind of gauge like your main exposures, and who do you kind of talk to, and like kind of build that trust internally to figure out where these exposures are?
Yeah, I mean, I think it depends on a number of things. First, it depends on the company culture and the culture towards risk and the buying attitude towards like insurance, because some companies purchase insurance to stabilize their P&L. So to elaborate on it, if you buy insurance and you buy insurance, you don't have to worry about a loss because insurance will pay for it. So a lot of companies, there are a number of companies out there that will purchase insurance so their financials will be stable. It's limited to what the premium that you pay. Others like to spend less in insurance, invest more into risk mitigation and safety procedures. So in the past 3 years, when we're kind of in a hard cycle right now, you've seen more and more more C-level leadership team asking their risk managers, "Hey, why is our insurance premium increasing so much? What can we do to spend less on insurance or control the cost of insurance?" So there's the risk management, the kind of the day in risk managers has changed significantly in the past 5 years as well. Secondly, it could be finance driven. Bigger the company, they tend to self-insure more to reduce the total cost of risk. And if the company has, great loss control and safety procedures and the ability to pay claims, you could increase your retention because you could control your losses, right? And reduce your insurance premium. Third, some companies like to have a better grasp of their insurance claims handling. If you buy insurance and transfer the risk to the insurance companies, they manage the claims, they handle it, they settle however they fit. Versus if you self-insure, have high retention, deductible, you have a better control of how you want to handle that claim. And then the last reason could be business operation driven. So you really do need to understand why your company buys insurance, because it could be minimum requirements of a contract that you have with a customer, the type of insurance and the type of industry or products that you sell, or who your products are being sold to, may determine if you need to buy insurance and how much insurance to buy. So like an example could be like a paper manufacturer has probably a very low chance of getting sued, so you buy less products insurance. But your property risk is very high, so you have to buy a bunch of property insurance. Versus if you're a consulting firm, you have very low, general liability or products liability. However, you have a very high professional and E&O, errors and emissions liability. So it really depends on your operations too.
Yeah, no, that's a really interesting way to put it, of like the culture, because like when you first say culture, you wouldn't really think about their attitude towards risk, like as a company's culture, but in this instance, like that makes so much sense of like how the company would approach risk kind of determines like how much of it they're comfortable with, and then how much they're comfortable with this risk kind of dictates like how much premium they're willing to spend, how much limits they want to buy. And then also, as you said, at what point are you buying more insurance, or are you, investing money into like loss controls and reducing potential losses?
Yeah, I mean, again, all of those are very important, and there are companies out there that are more than happy to just buy the same insurance over and over and over for the next 10 years. And there are companies where they're always driving change. So there's a number of factors that go into it. Nothing fits the box right perfectly. Not one way fits the box perfectly. But however, it's just one of those things where Regal Rexnord brought me into the company to look at different ways, because they have been kind of stagnant each year. And I really do enjoy having the opportunity to look at different ways of financing risk and looking at alternative risk transfers.
Mm-hmm. So kind of in that planning stage, how do you kind of approach that, like with budgeting or kind of factoring in like consulting, or if you're bringing in like engineers to do inspections on properties, and then also just with like the cyclical nature of the insurance industry. Like 1 year your premium might be going down, 5% for the last 3 years, but then next year you might get a 50% re-increase across almost all your lines of coverage. Like how do you kind of balance that? Because the people you're reporting to might see the cost going down and they might want to like shrink your budget, year to year, but then you might have that feeling that we might be going into a hard market and the rates might increase more than your budget for it.
Yeah, I mean, first, it's important to note and understand that although insurance, a lot of people in the insurance industry know that insurance is cyclical, and but it's really difficult to time when you're going to hit a hard market. When it's in a soft market, when there's a lot of capacity out there, there's a lot of insurance companies are there's willing to offer coverage and high limits and at competitive rates. Those are good for risk managers and corporations, but as we know, history tells that hard market does come every 10, 15 years, and it's really hard to time that. So as a risk manager, it is our job to ensure that the company, even though the premiums are going down, that we invest those savings into improving the company's quality of risk. So when the time does come that it becomes a hard market, you're now a top tier risk that everybody else, every insurance company wants. And then you have although premiums have gone up and rates have gone up, that you're in the top tier where you will get the best rate out of them. So it's those are the and then again, if you work with the same underwriter or insurance company for years, even though you're at a hard market, they know that you're such a good risk. They don't want to lose you as a client because you're a good risk. So they're going to do their best to reduce the increase of the rate or premium, ensure that they continue to be their client.
Yeah,
that's the first. Go ahead.
Yeah, I was just gonna say that's a really interesting way to put it, of just kind of like being that top tier risk and preparing for that kind of uncertain future of just kind of with the concept of like the risk pools. If you're either like at the the least risky in that group, or you're the most risky, and at some point some companies might not even be able to get any insurance, because if they're like seen, like right now I'm working with some cyber insurance, and like some companies, if they don't have certain controls in place, like the carriers will they won't have to offer insurance because there's so many other insureds out there that they can insure. So like in those hard market times, the carriers are able to be more selective with not even how much they charge, but also where they want to like put up their capacity. So I think that's really cool, of kind of like having that future like planning in mind, and like, oh, like this might happen, let's get ahead of it. I think that's kind of a unique perspective.
Yeah, and it's important to have leadership understand that insurance, it may seem like it's a commodity, but it's a way of transferring risk. So you pay an X dollar premium and they insure you to an X amount of limit, right? And it's sometimes, depending on the industry you're in and the type of insurance, it's almost a privilege for insurance companies to offer you coverage. So if you're a bad risk in a hard market cycle, it's not a good place to be. And you need to make sure, again, we don't know when that hard market's going to hit again, and we do need to be prepared to make sure that you continue to improve your risk quality. And I know cyber is a huge topic now, but it was property 5 years ago, and it was D&O 10 years ago. So there's you never know which insurance line is going to significantly go into a hard market cycle.
Mm-hmm. Can you go deeper into kind of what you were saying of communicating with your managers? Maybe they're more on like the finance side, or more like the CFOs versus kind of like that insurance side, maybe like you kind of speak a different language to an extent and kind of maybe like educate like that side a little more, and just kind of like because there might be kind of a gap in understanding with that. And then we kind of talked a little bit about like the centralized versus kind of
Yep.
decentralized models. If you can kind of explain that a little bit.
Yeah. So again, I think communication is very important. You know, number one, not only internally but communicating with your risk manager peers, in your risk, in your RIMS community, brokers and insurance companies. It's going to be very important because they're the ones that are going to have the first hand or first insight on, are we approaching a hard market? Which insurance line has been a difficult renewal? What can we expect? Who's been good to you? So I think that's very important. And you need to have that knowledge base so you could prepare your internal stakeholders, like your executive team, and letting them know that, hey, we should expect a X percentage increase because it's, that's what my peers are experiencing. So that's very, very important. But in terms of that corporate overview, you're right. There's the decentralized or there's a centralized and a decentralized, or like a holding company type of model, where centralized insurance is handled by a corporate function. Most risk managers and companies that have risk managers fall into this category where, you're negotiating insurance on behalf of the entire corporation, and those costs are then, allocated by segment, by revenue, by the entities, and are split out. The benefits of that centralized model is you get the purchase power of the whole company. You're now negotiating on behalf of a multi-million-dollar, billion-dollar company versus small companies as a whole. So you get that negotiation power. You're able to drive rates down because you're a bigger company, and then you might, because you're now a larger company, which results in a larger premium, you might have more leverage and additional coverage and achieve economies of scale. The consequences of that are a bad experience at one product line or one entity could affect or impact the rest of the corporation. So, a big loss at, a single entity may drive insurance cost up for the, 5 others that might, be consistent in your corporation. There's a decentralized model where Regal is although I negotiate on behalf of mine as a corporation, a lot of the changes and the retentions and the costs are pushed down to the different segments that we have. Which again, those are good because exposures for individual business segments are addressed separately. So each business segment, you could address a claim or things that happen in a specific interior segment could be addressed individually, and you could, prevent it affecting your entire risk profile. But the consequence could be you might not be able to take advantage of the large, the purchasing power that you had, and also may create additional administrative work. Regal is kind of a half and half way where we are centralized in some of that function, but again, I negotiate on behalf of Regal Rexnord, and then we decentralize on the back end to the different segments.
Yeah, no, it's definitely an interesting explanation there. So kind of with like that centralized model, it makes sense that you would have more buying power. So then you might be able to get more underwriters' attention. They would see it as kind of a bigger account. Maybe the brokers would kind of give you more attention with that concentrated buying power as well. But then as you said, like there's a lot of work to be done on like clarifying the intent of coverage to kind of make sure that like each individual business or like entity has coverage, because they could be doing different operations and they can have different exposures. But if you're making it very centralized, then you need to make sure that all those exposures are addressed, and then you're probably going to end up paying to have, that manuscripted policy on the back end.
Correct. Correct. And then, the more purchase power you have, you have more flexibility on, a company manuscript. Manuscript, it's a good concept, but you'd be surprised you don't really run into, there's specific sectors that you run into it, but correct. It's negotiating insurance for a corporation as a whole is one of the main benefits. But again, it does depend on the company culture, because if you're a private equity or a holding company, you want it to be separate, because you don't want a specific company within your portfolio affecting the rest of the business. So I know like Blackstone negotiates on behalf of each entity or company that they hold within their in their portfolio.
Mm-hmm. And as you're kind of saying, Regal's in the decentralized model, and then you kind of were telling me that you just kind of went through like mergers and acquisitions with like the companies, so that then you had to go through the process of kind of lining up, like is there any overlap in operations or overlap in exposures for, like, are they kind of combining and becoming one bigger business unit, or like where's kind of the overlap for negotiating with like terms and conditions for it with the brokers and with the carriers? Can you kind of describe that process of the merger?
Yeah. So it was prior to the merger, our company was called, our name, Regal Beloit Corp. We purchased a company called Rexnord. 80% of, we purchased the process and motion control of Rexnord Corporation. So now, since the merger, our company name is Regal Rexnord Corporation, and there was a $3.6 billion a merger / acquisition. And no, it was a tough task. First, anytime you have that large of a scale of M&A activity, you first need to understand or analyze the risk profiles. Although it might seem like the same company, you need to truly understand what products they sell, how do they align with the products that we sell, and the loss history, what type of losses have they had, compare the types of insurances that they purchase. So you align literally line by line of everything that they purchase, why they purchase it. Then you identify your broker relationships, your insurance carrier relationships, and other vendor relationships that they have in place. You also need to get together with and then you have the brokers to do a coverage comparison, coverage analysis, to ensure there's no gaps when you roll the company into other. And then there's the and then you get to understanding the business operations of why do they purchase such insurance at X limit when we buy half of that.
Yeah.
And it's truly understanding that, and it was like a 9-month integration process of trying to going back and forth with their risk manager to ensure that the company that we're acquiring is adequately has insurance, and the insurance that I also need to figure out synergy savings and determine which insurance we no longer should purchase, because we think either self-insured or we already have insurance elsewhere. So it was a tough task, but it's in any acquisitions or any M&A activity this size, you truly do need to understand why something is being done in a certain way.
Yeah, I mean, that's interesting too, of just kind of how you said lining up, one company, another company, line by line, and then like you said, that the synergy savings, like there's actually, like, I think that's kind of cool how you can save money, like even though your company as a whole like got bigger, like there could be some redundancies in coverage, or like you said, benchmarking wise, you might be able to purchase lower limits, and like just like overall saving that money for the company. Like if there wasn't a risk manager there going over that, then the insurance costs could have like exploded, if somebody wasn't they're like going through that and doing like diligence on that process, like they wouldn't have had those savings. They might have had gaps in coverage. Then also like they might have even ended up spending more money on insurance.
Correct. And it was also, again, anytime it's this big of a M&A activity, you get a lot of questions of, well, how come their insurance was cheaper than ours? And, you know, are their brokers better than ours? And so those questions come up, and it's help, you know, kind of hand holding the segments and your leadership team to just explain to them that, you know, although they look similar, risk profiles were different, and here's why. So that it's important to review every aspect of the risk profile, the risks out there, their claims history, and then why they purchase insurance, or why is their insurance structured the way it is.
Yeah. So can you kind of describe what happens once, you know, you get the quote, you know, in hand? Like obviously like the brokers are bringing you the quotes, and then like you might have multiple options for multiple different lines of coverage, and like you have to kind of know you're insured enough to like condense that. And then what are you showing, like 2-3 options to like your managers, or how does that kind of process go? Because like I'm sure you don't have like the time or energy to like present, you know, like 10 different quotes from the market for, you know, auto, general liability, and property, and all other lines of business.
It depends on what you're trying to achieve and what kind of circumstance you're in. So if there's a line of coverage that you had a good loss history, and most risk managers, at least the ones I know, don't market every program every year. It becomes a lot of work. And so if it's a good performing line of coverage and the incumbent insurance company have not given you much issues with the renewal quote, it's, you know, same rates or better rates than you expected, I am not going to go market the program. It's going to be the same. You know, I'm just going to present that one option, as long as there's no surprises. If you're in the past, like a cyber, for example, cyber insurance has been a big topic this year. I believe we approached like 25 insurance companies, and even with the incumbent insurance company that we had a significant premium increase. So for me to show to my leadership team on why our premium is 3-4 times higher, and however, this is the amount of effort that I've put in and the brokers put in, and this is where we stand. This is actually the best possible quote we achieved, to show that you're going to actually show all 10, 15 quotes that you received. It might be just on a spreadsheet where just a quick hit, or you do it on like your monthly reviews with your supervisor, or, you know, with the CFO and the general counsel who I report to. So it does vary on what you're trying to achieve. So, you know, that's the insurance renewal, but also like if I'm proposing that we set up a captive or do other different types of alternative risk transfers, you just need to make sure you have the right audience in front of you, and they may not want to see every option. They may want to see the best option there. But again, I think it depends on who you work and the level of trust that they have. And it's not really the level of trust, but you got to think, I only sit down, I've only worked on insurance every day in and day out. Because that's all I look at, you know, my focus might be elsewhere, right? So it's having that multiple set of eyes to look at it too is also helpful. So sometimes you may want, you know, someone that's non-insurance related to review all the quotes or review all the options to see, you know, why this is the way. So I think it does vary on circumstance you're in, the type of line of coverage, and also the culture that of the company or you know, the person they report to is in.
Yeah, I think that's interesting of what you're saying, of like it depends on like what situation you are in. You know, if you have to deliver like 100% increase for cyber, like you kind of need something tangible to come to the table and show, kind of like cover yourself in a way of like, hey, like I did the best I can, my brokers did the best they can, like this is just how it is, and here's, all the quotes that I have, and they're saying the same thing. It's the market. And I think that's kind of interesting. And kind of on that note, like of lining up, the effective dates for like renewals. If you have all the effective dates on the same day, same calendar year, all renewing all lines of coverage, that might be kind of hard to gather all that information and just have that like rush, like 90 days out, 30 days out, like up until that effective date. How do you kind of determine how to split effective dates or renewal dates with your coverages?
That varies as well. So it depends on Takeda. Our renewal periods were aligned, so it was in line for the following year's budget. At Regal, again, I've only been here 9 months, and there are some of the reasons why I think it has been split up. So some of our budgeting needs to be approved by our board members by X date. So, some of our D&O renewals like middle of the year versus, property workers' compensation spend, we need to know more for the following year's budget for our segment. So that's later on in the year, that's the October and November renewal. So I think it does depend on, there's typically a reason why it's done, but again, there's reasons that it can be a different way. So a lot of companies match it with their fiscal year or calendar year. So that's typically how it's done. But if your fiscal year is January 1st and your insurance renewal is January 1st, you may not, the final budget, final premium may need to be known at the end of October, end of November, and you may not have the final premium that way. So you have your insurance renewal at 11/1. So you know what the total cost is for the following year. So I think it does vary. Some do it to split the workload up. So not a lot of companies have their insurance renewals either 1/1, 7/1, 4/1, 12/1. So they break it up so you work with underwriters that are they're in a less busy time. So it really does depend on various number of things. But unless you have a big team working on your insurance renewals, for me, I like to break it up because now you don't have to provide renewal information and compare quotes for 20 insurance policy you purchase at the year end. So it does vary. Some risk managers like to do it because it's broken up. Some do it because it's require them for budgeting purposes or fiscal year purposes.
Yeah, no, thanks for that overview there. Well, Seung, thanks for so much for being on and just covering the day-to-day of a risk manager. Definitely a very interesting career path, and I'm sure the listeners will really appreciate your time here.
No, thanks for the invite. Really enjoyed the time. Hopefully, we could see each other in person again soon at a future insurance event. But again, if you need anything, please let me know. But again, I really had a good time. Enjoyed it. Thank you.